you just be very careful though. It's not always that easy to find the fees you're paying in super. So I had a client, 500,000 in super. He comes to me, he says, "Oh yeah, I'm paying $78 a year in fees." I said, "No, you're not. Yeah, absolutely not. You're paying about," because I knew the fund he was in, "you're paying about 1% in fees, which is not uncommon. So 1% of 500, $5,000 a year." And he was shocked.
Every year, thousands of people migrate to other countries in search for a better life.
Each one with a story to tell of courage and determination.
Adjusting to a new country is not that easy.
Here at Migrant Tribe, we honor you.
So join us as we share our stories from our journey down under.
Hello, everyone. Welcome to the Migrant Tribe. Stories from our journey down under, episode 31. This is Joseph. Together with me are the other members of the tribe. There's a John. Hi, John. How you doing?
Hi, everybody. How are we?
Okay, then there's a Joey. Hi, Joey.
Hello, everyone. Thank you.
Oh,
How are you, Joseph? How's everyone?
Good. We're doing good. Thank you. Okay, so today we'll be talking about choosing the right super fund for you. Okay, we all know, like, if you want to aspire for a certain type of lifestyle after you retire, it's very important, it's very crucial to choose the right super fund for you. So to be helping us today with that task is a financial planner. Okay, his name is, I'd like to call him now, Mark Kruger. Hi, Mark. How you doing?
Good, thanks, Joseph. I apologize, my name doesn't start with a J.
Okay. Oh, you did notice that. Okay. Well, so a few questions. So how long have you been a financial advisor?
Yeah, so I've been in the industry for 3 years now. So I have a slightly different background, which I think lends itself well. As in, I was a concert pianist many years ago for the first half of my life. Long story short, I got sick of that. I moved into finance. I always had a head for numbers, and they talk about a lot of connection between maths and music. I love numbers. I love balance sheets. I love finance. So I worked at Ernst & Young for 4 years in valuations and business modeling, valuing businesses. And then my wife and I lived down in Ocean Grove in Victoria, not far from Melbourne. And so at that stage, I made the transition into financial planning. So it's a blend of the finance and the softer skills, relationships, and with people. And my clients are individuals and families, and doing all I can to make them better off and get them all set up.
Okay, and so how's it been so far?
Great. I love it. I love being self-employed. So Money Rocket is my business. It's just me. At the moment, I will need an assistant, not too far off. But I launched on 1st of July last year, my actual company. So in the midst of COVID, my business is basically 100% online. I do meet clients face-to-face when I can and where I can in Melbourne, or if I'm traveling, but most of it's online, and I love it.
Okay. So to kind of, let's say, so to speak, dive into talking about a super fund. Correct me if I'm wrong. Isn't it like a couple of years back, you would have to rely on your employer's super fund, and I think it's only kind of in the last couple of years where you actually have a choice on which fund to choose. Is that correct?
It's different. Some employers, there are different schemes. Basically now, you can choose whatever you want. Some employers still have an enterprise bargaining agreement where they require you to be part of their fund, the one that they use. And look, if I've had that come up with clients before, and if it's optimal, if someone's in fund X and it's optimal to move to fund Y, we can just keep a small balance in fund X to keep it open, and have the bulk of their super in fund Y. And sometimes we do that for insurance purposes as well, because you might want to retain the insurance in fund X, but you want the bulk of your super to be in fund Y for whatever reason, fees or the investments. But that, correct. Okay.
So you do kind of espouse having a balance, to have more than one fund?
Look, ideally you would have one, and the reason for that that's often quoted is fees.
Yep.
And if you're paying a flat fee, say call it $78 or $104 in 3 or 4 different funds, obviously that's not optimal. So usually you would try and just have the one, but there may be certain cases, for example, someone started a fund 10 years ago and they've got insurance and now they've acquired an illness. And so they need to keep that insurance. They really want to keep that insurance. So you have to be careful when you're thinking of, I'll just switch super funds.
Right.
It is fairly easy to do. It's not hard, but what about that insurance? Because when you go to the new super fund, suddenly you've got a pre-existing condition.
Good point there.
So sometimes planners, it's very common. You will keep just a low balance. When I say low, maybe $6,000 to $10,000 or something in a fund just to keep the insurance, because it will cover you for that condition you've acquired. Okay. And so you have to be really careful with that. And there've been, cases before where, people in the media might say things, switch super fund and all that. And people get all self-empowered. And that's a good thing. We want people to be engaged in their finances, their super. They think, I'll just switch to this one because I'm going to save $50 on fees. Well, hang on, there's insurance as well.
Right. And sometimes I think one of the things that can attract to just put them in one is because, I get a better rate here, let's put it all here kind of thing mentality.
Yeah.
Okay.
Yeah.
By the way, we might need to mention just whatever we say here is actually general in nature. So I think if they want to know more later, to get more in depth on every aspect of their finance condition, they have to talk to Mark directly, just so everyone knows.
Yes.
And thanks for that, Joey. And I should have said up front, anything you hear tonight is just general advice. I'm not going to actually say anything that should make you go, I'm going to go and do that.
Right.
Because it's so different for everyone. I'll give you the general rules, how it works, things to think about, but always go out and either come to me or see someone you trust, a financial planner, to see if it's right for you.
Okay. So
having said that, during the pandemic, and we are still in the pandemic right now, can you give a case study of, say, for example, how to at least protect your super fund, if not increase the income out of it?
That's a
Just
wonderful
a case study. Just a case study. So, although you said it's general in nature, but if you have something in mind that you did do in the past that you can expound on.
It's something like, okay, it's an interesting point, because something like COVID you can't predict. Okay, no one can predict that. Yep. It depends. Look, I think a thing to realize in super is that you do have control over it. And again, this is not a recommendation by any means, but you can, if you're in an industry fund and you're in the growth fund, for example, I will come back to your point. I'm slightly digressing now, but people should understand what that means. Firstly, they should know what they're invested in, in their super. Is it balanced growth, high growth? What combination of funds, and what does that mean, and why, and how did that come about? Because that is a hugely important driver of your long-term wealth. Okay. And so within that, especially say with the industry funds, within the balance fund, there are bots on seats, or not bots. There are finance people, making changes to their investments all the time. So your balance fund might have a notional 70% growth assets, 30% defensive. They'll be tweaking that. And so during COVID, when the market just tanked over a very short period, many of them were adjusting their allocations under the hood. And unless you go in and look, you wouldn't really know.
Yes.
You think, I'm just in the growth fund. So they say, well, we've got 70% growth assets, but they have a range either side. So during COVID, they might tweak that down to, I'm guessing, say 60%, when the market's going up, they might tweak that to 80% to get more returns. So there, in those types of funds, there is an element of self-management within it. And so you, to some extent, you can let that ride. And there are so many points that your question raises. The other thing is that super, for most people, is a long-term investment.
Yep.
Okay. Now, if you look at any stock market chart and it bounces around, there are so many things week to week, month to month, year to year, crises, wars, taxes, tariffs. It just goes on and on. There is so much noise that a lot of people would say, well, we're just going to ride that out over the next 30 years. That's one approach. I'm not saying that's the correct approach, or you should do that. Other people, to address John's question, is saying, well, what are you going to do if COVID happens? And so you're suggesting a more active approach, and that I want to get in there and make some changes. So I do have a client who is very much that. And for most of my clients, we're saying, okay, we're going to make those kinds of tweaks like I was just talking about. But this guy, no, he wanted to move from his high growth to cash out. Okay, now that's totally his call. It's a client directive. So we will educate about pros and cons of doing that.
So, so Mark, so let's say, do you have kind of like a short checklist on what to look for in the different funds? What are the things that you should be looking into before deciding if you want to, you know?
Sure.
That
Yeah.
fund?
So look, two main drivers. Obviously, fees is one, and it's common sense. Lower fees, the better, right? I think you just be very careful though. It's not always that easy to find the fees you're paying in super. So I had a client, 500,000 in super. He comes to me, he says, oh yeah, I'm paying $78 a year in fees. I said, no, you're not. Yeah, absolutely not. You're paying about, because I knew the fund he was in, you're paying about 1% in fees, which is not uncommon. So 1% of 500, $5,000 a year. And he was shocked. Now, a lot of those fees, when you get your statement, you will see an explicit, you know, $1 per week or whatever it is. But there are various other fees that aren't necessarily stated on the on your statement. So you can imagine if your investment earned 10% and there's a 1% fee, it will show on the statement as a 9% net return. So nowhere does it say minus $5,000. So he's not seeing that. So that's one example. The fees are often built into the returns. And sometimes in the PDS, the product disclosure statement, it's a bit hard to piece together. Sometimes the fees are on different pages and you have to piece it together a bit. So there's a little bit of an art to that. The other, look, the biggest driver of returns or not returns, one is behavior, investor behavior. So, you know, we that's not your question, I know, but the other one is asset allocation. And there's plenty of evidence around that. And what I mean by that is not stock picking. It's not saying I'm going to, you know, buy this one today, sell this one tomorrow. It's about how many. So you can imagine if you've 100% invested in cash, well, you're going to have very low return. Okay, very stable,
Right.
but very low return. If you're 100% in shares, you'll have a higher return long term, but it's going to be very volatile. We've all seen the stock market charts on the night. Okay. Now, most super funds or a lot of people are invested in some blend of that. I don't know anyone who's 100% in cash. Some are 100% in shares. Some might be 80% shares, 20% cash, 70% shares, 30% defensive assets. So really important that you look into your fund and know what you're invested in and decide, and there's no right or wrong, is that right for you? If you're 25 years old, 35 years old, you're not getting your super until the age of 60 at the earliest, if you satisfy other conditions, or potentially earlier if you satisfy other conditions. It's there for a long time. So you have to ask yourself, do you really want those defensive assets sitting there? Or are you prepared to see that volatility, you know, in your returns, in your profile? There's no right or wrong. It's your money. I say to my clients all the time, I say, it's your money. You've got to sleep at night. It makes no difference to me as an advisor. but you have to be aware of that. And it's not just a question of when you're, young, 20, 30, 40 years old. What about when you're 58, thinking about retiring? Do you want that asset allocation? And what happens if you don't make a choice? When you join a job, your employer will say, if you don't tick a box, I want this or this fund, they'll put you in often what's called a My Super fund, or a growth fund, or it might be called a balanced fund sometimes. Terminology differs. But that will be usually something about 75% growth assets and something more defensive. And there's, again, no right or wrong. You just have to make sure that that's right for you. So fees, asset allocation. The other thing to think about is ethical investments. If you've got a certain slant towards that, then most of the industry funds, most funds have a ethically or a socially conscious fund. Go and look under the hood to see what's in there, because how green is green? I mean, just because it's not investing in guns and cigars and pornography or whatever,
or alcohol,
doesn't mean, they might be lending, might be investing in banks. Well, those banks lend to coal miners. Is that okay with you? So you just need to be aware of how green do you want it? And there are specialist funds that are even vegan or have a certain slant. Often you will pay more for that privilege, so you have to weigh that up, because to invest in that funds requires more scrutiny, more analysis, more looking into companies to see what they actually invest in. That's someone's time, so you have to pay for that. So there's usually a trade-off in these things.
Okay.
The other thing to think, look, and I don't know exactly who's watching, self-managed super funds may be appropriate for you or not, depending often on balances, but on the level of engagement you want to have with your super and what you want to get out of it. It can be right for some people and not right for others.
Okay. So I'll be honest with you. I haven't really studied my super in depth so much. You kind of figure out, no, all supers, they're the same, just figure it out. I know what they're gonna do, but thank you. I probably should be doing that.
I think when people think of super is just an investment like any other asset.
Yes.
So you can invest in, let's say you're going to invest in a certain share on the Australian stock market. Name a top 200 share. In your super, most super funds, or a lot of them, you can go and invest in that exact stock. So you've invested in stock A in your super, stock B out of your super. Super is just an investment, but it's a tax structure. And what that means is there are certain rules and benefits to get money in, certain rules around the tax when the money's in there, and certain rules getting it out. That's all it is. You can tweak your investments, do largely what you want with your investments in super to an extent. So, but the benefits, if that stock is going to return 10% a year out of super, or 10% a year in super, long term, you're way better off in super, purely because of the tax.
Okay.
Purely because of the tax. Now, assuming that you've got taxable income.
Right.
Okay. But the downside is you're not getting that money till later in life.
Right. So it's.
But it's people shouldn't think of super as something different. It's like, I've got my super, but I'm going to get some shares as well. You've got shares. You've got shares in super. So know what you've got there. And that's, if you've got money out of super that you might need in 10 years or whenever, well, that's a different question, because you've got that shorter term need. And depending on that need, then you think of the structure of kids' education. There's a certain type of structure. There's always ifs and buts. In whose name should it be? It should be in your name, in your partner's name, in joint names.
Okay. Good.
Mark, I think we have multiple questions ahead for you today, but in a sense, probably in a nutshell, the idea that we're trying to brought out here is for people to actually have more control about it. I mean, obviously, it's not money that you can actually take out right away, but we could at least have a bit of control. I mean, where it's being invested on, and yeah, I think we'll proceed with the next questions. Enlightening us, thank you for sharing this information this time.
Okay. Yes. In our last episode, we had an accountant as our guest, and he kind of mentioned something about salary sacrifice. So my question is kind of like, so you kind of touched upon it already with your answer about super as opposed to just buying straight stocks, but like, so pros and cons between salary sacrifice versus investing in shares. What's your take on that?
Yeah. Well, and that's, again, think of, so let's strip out the variables. So think of, again, if you're investing in shares, it's going to earn a certain return. Okay. Say it earns, you've got $1,000, it earns 10%. So that's $100 of earnings. If it's out of super, depending on your tax rate, you're going to pay tax on that $100.
Exactly. Yep.
Now, say you're on a 34.5% tax rate, including Medicare leveling, you're going to lose $34.50 straight away. In super, if you've got $1,000 and it earns 100, you're only taxed at 15% in super.
Oh.
So you're left with $85. So imagine that, multiply that by whatever to think of larger amounts in super year after year after year. That difference is enormous.
Yep.
And that's what I mean by a tax structure. It's all about the tax. I'm not talking about better returns in super or better returns in shares, because you can do whatever you want in super, just like you can out of super. Okay. So salary sacrifice specifically is, and let me talk about one other benefit, that's getting money into super. So if you were salary sacrificing, you say to your employer, hey, instead of me taking a salary of 100,000 this year, pay some extra into my super, pay an extra $10,000 into super. That's salary sacrifice. So instead of being taxed on $100,000, you're taxed on $90,000. So that 10 goes into super. It's gone until you get it later in life. It's working for you, it's earning. But now you're taxed only on $90,000. So that difference, off the top of my head, I haven't got the tax rates in my head, but that's roughly a third. The difference, say you've saved $3,000 to $4,000 for that year in tax. Okay, so do that year after year, and that's pretty substantial. So you're going to have lower cash flow because now you've only got 90,000 less tax. You're going to have less cash in your hand, so you have to be aware of that. But you've got that money working for you in super. So if you've got that surplus cash, you can be putting that in. And again, it's not going to be right for everyone, because people come to me and they say, hey, I want a salary sacrifice. It's a great idea. It's a great idea for anyone. But hey, you've got 20 grand credit card debt. Maybe you should be paying that off first before you put it into super. So, and again, they might say, oh, my wife wants to put some in super. She hasn't been working, low super balance. Yeah, but she hasn't got as high a tax bracket as you. You're actually better off putting it in your name, the higher income earner, to get the tax. But okay. So there's always that's why we say, when we say general advice, it sounds like we're on a political ad or something.
Right.
We mean it. We absolutely mean it, because it differs all the time. The other thing with salary sacrifice, say if you earn that 100, you don't salary sacrifice. You get to the end of the financial year, you get to April, May, maybe you built up a few $1,000s in your account, and you think, gee, I wish I had a salary sacrifice that would have been really good. Well, you can still do it. You can take that, let's just call it $10,000, put it into super, claim a tax deduction on it, and then you will get more tax back than you would have otherwise. So salary sacrifice can happen through the year, where it just your employer does it for you, or you can do it yourself at the end of the year and throw that money in super.
Mhm.
Okay, but here's another one.
Yes.
You have to be careful of the caps. There are limits as to
That
how
you
much
can contribute, right? Yes.
and your employer contributions contribute to that. So you just have to be very aware of that. I won't go into the detail, but that is a point to say, get personal advice about that. You can Google it, look it up and all that, but speak to someone about that. Because if you get it wrong, you're up for big tax penalties.
Right. Correct.
Yeah.
And-
Well, probably just a quick question, just Mark, is what's the age that you can get into super? What's the youngest age you can get into?
So at the moment, it's 65. You can access it. Is anyone
So
at age
to
65?
start saving for super, what's the
Oh,
youngest-
sorry.
No.
I thought you meant to get it out.
For someone who's employed, I
Oh,
think.
to get into it. Well, with your first job,
Yes.
you know. I haven't had anyone that young coming to me wanting to start super, but I actually don't know if that's 18 or 16 or what it is, but yeah,
Okay.
that's a good question.
So
Yeah. Oh, mhm.
to kind of wind us down. So Mark, so let's say I'll give you please talk to our tribe. Tell them, invite them to your coaching on your coaching website, and what your approach would be and how you can help them out.
Yeah, sure. So they're at various phases. It depends what phase of life you're in. So usually, I've got clients. This is okay. I am answering your question, but in a roundabout way. A lot of people think you need a lot of money to go and see a financial advisor. You don't need a lot of money. I have clients who have $20,000 in super, and they're in their mid-20s, and they're earning sort of average kind of income. They're not superstars or anything yet, but by tweaking those fees, getting that asset allocation right, that will save them tens of thousands over the course of their super in today's dollars. Okay, so that's the first port of call. So if anyone's sort of interested, they can browse my website and they can book a free chat. I'll talk to anyone. Just book a time on the online calendar and we'll have a chat. And I always say advisors we have a legal obligation and an ethical obligation to show best interests. So I have to demonstrate, and I want to demonstrate because it's just the right thing to do, that if I'm going to help you, you're going to be better off. Okay, otherwise, why would you pay money? So if you're going to pay X, I want to make sure you're better off by way more than X. Another thing with super, especially for the young'uns or anyone buying their first home, you can use your super as a way to save for your first home. The government will give you tax benefits.
Oh, good.
Different to the ones I've just described. It's called the First Home Super Saver Scheme. I won't go into details because it is quite intricate, but that's another one people should think about. And these two clients are using that because they're going to buy a home in the next 1, 2, 3 years. So they're parking money in super and getting additional tax benefits, and then they'll be able to use that. So that's a great thing for them. As I was saying before, we've got them in a for them a better super fund. So we've looked at the insurance, make sure they're not any worse insurance wise. They're young, so they can get cheap premiums. They're healthy. They happen to be in low risk occupations. So we get that sorted for them because they're partnering up and they're about to have a big mortgage. So it's getting that sorted. And then later in life, it's about, when you have children, the higher insurance needs. Kids go to school, maybe the other partner starts working, there's surplus income. What should we do? Is there some education fund? Maybe it's an investment property. Maybe it's shares for something else. People receive inheritances. What should we do with that? So these things don't change week to week, month to month. These things change slowly over the year. And that's where having that financial planner sort of by your side who knows your history. I always imagine, like, if you're driving around Australia in a car, you're going to break down at some time, at some point. Ideally, you'd have the same mechanic with you who knows your car, he knows what's being done, who knows. And that's the benefit of a planner, managing all those investments and structures and your life, and that they can see what's coming, and getting you to retirement and then further into retirement.
Okay. Well, thank you. Thank you so much, Mark. You know what? Definitely we're going to have you back again here if
Right.
because you mentioned so many things that all of a sudden, oh wow, I hope
There's a lot to talk about. Yeah.
we can get you back sometime in the near future. So again, thank you again, Mark. So yep. So as we end this episode, yep, this is Joseph from the tribe. Thank you for everything. See you next week. Don't forget to like and subscribe. Bye.
Thanks for having me.
Thanks. Thanks, man.